Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money circus so you don't have to. Today we're diving into Alussa Energy Acquisition Corp, to a company that's looking to make some big moves in the energy sector, but first they need to get their ducks in a row for a major public offering. Let's see what's brewing. So Alussa Energy Acquisition Corp is essentially a blank check company, which means it's a shell company looking to acquire another business. They are planning to sell 25 million units, each unit costing $10. Now, this isn't your typical IPO because there isn't an actual operating business yet. It's more like setting up a fund to go shopping for one. What's really interesting here is the deal structure and the people involved. Their sponsor, Alussa Energy Sponsor 2 LLC, is buying a bunch of founder shares and private placement warrants for a pretty small amount of money. An entity owned by one of their directors paid just $25,000 for over 7 million Class B ordinary shares, which then went to the sponsor. These founder shares will likely dilute the value for the public shareholders after the initial business combination. The sponsor is also buying 2.5 million warrants at $1 each, another significant chunk of the company. This setup right away tells us that the sponsor has a strong incentive to get a deal done, possibly even more than what's best for the regular investors in the long run, because their initial investment is so much lower. Now let's look at the money. They are aiming to raise $250 million from the public offering, and then another $2.5 million from the sponsor's private warrant purchase. Out of the total proceeds, a cool $250 million plus some interest is going into a trust account. This is standard for these SPACs. Money held in trust until a business combination is found or the company liquidates within a specific time frame. About $1 million is being kept outside this trust account to cover operating expenses like legal fees, accounting, and administrative costs. These expenses, by the way, are quite substantial for a company that hasn't even found its target yet. Looking at their financial tables, specifically the dilution analysis, it paints a clear picture. As of the 30th of June 2025, their net tangible book value per share is actually negative. This is common for SPACs before they find a business to combine with. The key takeaway from the dilution table is how much the value can shrink depending on redemptions. For example, if there are maximum redemptions, the net tangible book value per share drops to a negative $2.26, assuming full exercise of the underwriter's over allotment option. This means that the initial investors are taking on significant risk, and the sponsor's low initial investment in founder shares makes their potential profit very attractive, even if the stock price falters after a deal. Their financial statements show a net loss of just over $1,900 for the 6 months ending June 2025, and around $74,000 for the period from August 2024 to December 2024. This isn't surprising for a company still in its setup phase. The real story isn't in the current operational numbers, which are minimal, but in the strategy and the risks. The risk factors section is extensive, as expected for a SPAC. One big point is that public shareholders might not get a vote on the business combination, or even if they do, the sponsor's founder shares help ensure it gets approved. They might also have to wait longer than 24 months if extensions are sought, and if they can't find a deal. The shareholders get their money back from the trust account, around $10 a share, and the warrants expire worthless. It's clear that the sponsor and management hold significant control, especially regarding board appointments before a business combination. This concentration of power is a key point for investors to consider. They also highlight numerous potential conflicts of interest, given that the management team and sponsor are involved in other ventures and may present opportunities to other entities they are affiliated with. The company readily admits they have no operating history and no revenues. Their entire plan hinges on finding and acquiring a suitable target business, which is a high-stakes gamble. They aim to focus on the energy and power infrastructure sectors, particularly those tied to renewable energy, with an enterprise value target of around $1 to $1.5 billion. This focus area is definitely hot, but competition is fierce. The leadership team is quite experienced, especially in the energy sector. W. Richard Anderson, the chairman, has decades of experience in energy finance and mergers and acquisitions. Ol Slaughter, the CEO, brings extensive investment banking and capital markets expertise, having held senior roles at Morgan Stanley and BT Benjamin Atkins. The CFO has a background in finance and was involved with a SPAC that merged with Core Scientific. Daniel Barcelo, a director, also has a SPAC background and is a founder of T1 Energy, which successfully merged with a SPAC. The board is packed with individuals who have deep ties to the energy industry and capital markets, which should be a strength in sourcing and evaluating deals. However, the filing is upfront about past performance, not guaranteeing future results. This is a crucial disclaimer for any investor. They are aware that their lack of operating history means you are betting on their ability to find and execute a successful business combination. The risks are high. And the success of an investment is entirely dependent on the execution of their strategy and the quality of the target business they eventually acquire. In my opinion, Alussa Energy Acquisition Corp, the second a standard SPAC approach, relying heavily on their experienced management team to find value in the energy transition space. The biggest stories here are the dilution from the sponsor's founder shares and warrants, the sponsor's strong incentive to get a deal done quickly, and the inherent risks of a blank check company. The experienced board is a plus. But the real challenge lies in finding the right target and navigating the complex business combination process while managing shareholder expectations and redemption rights. The potential for dilution is significant, and investors need to be aware that their initial investment could be worth considerably less depending on the deal structure and how many shareholders choose to redeem their shares. The company's direction towards energy and power infrastructure, especially renewable energy, is a timely strategy, but execution and market conditions will be key. Alright, that is our breakdown of Alussa Energy Acquisition Corp, the C's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.